Good afternoon, everyone, and welcome to today's webinar, Markets Unpacked Q4 Outlook. I'm Jim Zarosli, and I'm the voice of Trader Audio. You can hear me daily through Briefing.com's Trader product, and I am joined by our Chief Market Analyst, Patrick O'Hare. Pat, welcome aboard to our fourth quarter preview webinar.
Hey, Jim, great to be with you today.
Well, thanks as always. And we're excited to spend the next 30 minutes or so walking through the key themes that may be shaping markets as we head into the fourth quarter. Just a quick bit of housekeeping, though. This presentation is for informational purposes only. Nothing shared today should be taken as investment advice, nor should it be considered a recommendation to buy or sell securities. Remember, all investments involve risk, and you alone are responsible for any financial decisions that you make. Also want to highlight that today's session is being recorded and we'll send out a replay link afterwards. Feel free to submit some questions at any time and you do that through our chat, and we should have a few minutes afterwards for some Q&A. So as we kick things off here, we're going to go over Q3, give a little summary and recap of what we saw, take a deeper dive into a market discussion, and then, of course, save some time for some Q&A. So with that out of the way, Pat, Q3 was another headline-grabbing quarter. Can you give me some of the quick highlights of how the markets performed and what were some of the key drivers?
Sure, Jim. And first, let me just thank everyone today for being with us and really do appreciate it. And we'll try to be conscientious of everybody's time and not go on for too long here so that we do have some time for Q&A at the end. But yeah, the third quarter was another great quarter for the market. You can see here on this slide that there are three themes that kind of dominated. You had small caps outperforming, growth outperforming, and cyclicals leading. Those are all pretty good statements about the market's opinion of the economic and earnings growth outlook. Now, while there was a lot of attention certainly on those mega cap stocks doing extremely well yet again, fact of the matter is that it was the small caps that took the lead on the performance rankings in the third quarter. You can see that here on this chart with the Russell 2000 up about 12% as of yesterday for the quarter. And then you see a progression of sector bars here on the right side of the chart that indicate the outperformance of the communication services, information technology, and consumer discretionary sectors. All of those sectors house mega cap components, but right on down the line, you see some continued outperformance, primarily from those cyclical sectors, while the defensive-oriented healthcare and consumer staple sectors trailed in the quarter. Now, as we roll here into the beginning of the fourth quarter, showing you guys a chart here, as you can see how the trend has certainly been the market's friend. It's a nice trend line here off those lows in April that coincided with the pause in those reciprocal tariffs. And there's a reason for this that will be apparent in a slide I show you later in the webinar, but I'll give you a little hint. It has something to do with earnings as to why we see this nice encouraging trend line.
So, Pat, I want to interject here and talk a little bit about valuations. Now, we've seen valuations stretch to levels we haven't experienced in decades. So, how concerned should long-term investors be right now?
Right. Well, the fact of the matter is that there's a number of valuation metrics that do indicate that we're trading at some really rich levels. I'm going to show our webinar invitees here today several charts that reflect that point. This first one is the forward 12-month PE ratio, which you can see is roughly at about its third highest level since the dot-com days. We're trading at about 23 times forward 12-month earnings, which is a pretty rich premium to that 25-year average, which is just below 17. So one thing I would hasten to add, of course, and our viewers have probably heard this on a number of occasions, that you can't rely on valuation alone as a market timing indicator. Point out the famous quote from John Maynard Keynes that markets can stay irrational a lot longer than you can remain solvent. And what he was driving at there really was the idea that you can't bet against markets just because you think they are overvalued. They can stay overvalued for a lot longer than you might anticipate. So, but what these valuation charts do denote is that when you're starting from a point of a high valuation like we are now, future return potential is apt to be lower than it would otherwise if you start from a lower point of valuation. At the same time, it does introduce the risk of a greater loss in the event there is a fundamental disappointment that shows up to challenges the optimistic growth assumptions here. But you can see on these charts, the price to sales ratio at its highest point on record, price to cash flow certainly pretty rich here indeed. You can see in this slide here, the chart on the left, the S&P 500 dividend yield, sitting right about the level it was sitting at going into March 2000 or so, which, of course, that preceded the popping of the dot-com bubble. But it's also a reflection of the fact that you've had some really strong price performance here in the S&P 500 index. And so that dividend yield has been compressed as a result of that. Chart on the right is interesting, though. That earnings risk premium denotes that an investment right now, you're not necessarily being compensated that well for the amount of risk you're taking investing in stocks relative to the risk-free 10-year Treasury yield. So something also that kind of serves as a marker of how this market is looking pretty stretched from a valuation standpoint, just objectively speaking.
Pat, I have a question. We've talked about these high multiples, and do high multiples automatically mean lower returns, or can earnings growth still justify today's prices?
Well, earnings growth could justify the prices, Jim. And that's really the key here for the market right now. There's a lot of good news, a lot of good earnings news that's embedded in these premium multiples. And so that's why you've seen, and I'll show you our viewers in a little bit here, just the trend line and the earnings estimate trend. But that's going to be key here. If we're going to see continued multiple expansion, you see that earnings estimate trend line hold up. Because that's really the key to everything now, because so much good news is embedded in these rich valuations.
Well, with that being said, with these high valuations, we definitely need to account for risk. So, what fundamental shifts are at the top of your watch list that could upset the market in Q4?
Right. Well, whenever we talk about risk factors that could affect the market, we can get into go down a rabbit hole and list any number of risk factors. I've tried to highlight several here that are maybe some of the more prominent ones in the current environment. I didn't put them in any particular order, but I would say the first bullet at the top of the list might be the biggest risk, perhaps, and it relates to inflation. Inflation we saw in the personal income and spending report for August is still quite elevated, even though the market reaction to that report was pretty good. The fact of the matter is you've got a core PCE price index up 2.9% year over year. That's higher than what we saw several months ago in April when it was at 2.6% year over year. So it's not only moving away from that level, it's moving further away from the Fed's 2% inflation target. So inflation becomes a bigger risk factor if it really starts to increase again, which is going to certainly leave the Fed reticent to cut rates like the market thinks it will. And dare I say, might even necessitate a rate hike, but don't want to get too far ahead of ourselves here. We'll let the data speak for itself, but that's certainly a big risk factor. Some other elements to think about that could upset the apple cart here is an accelerated move in Treasury yields. Sometimes it's not necessarily the level that matters so much it is the pace at which the yield is going up. And so we need to be mindful of a move in Treasury yields that where we see things accelerate fairly quickly, driven by concerns that might relate to the markets thinking that the Fed or the government might be making some sort of monetary or fiscal policy mistake. Other considerations would be an increase in the unemployment rate in the face of sticky inflation here, because you're going to start hearing in that situation a lot about stagflation, particularly if that's accompanied by lower growth. That would be more challenging for earnings, for companies to deliver on the earnings growth that the market expects. Another key risk would be a sales growth or earnings growth disappointment from NVIDIA, right? NVIDIA is the largest stock in the market by capitalization. It's the AI leader, and there's certainly so much tied up in that AI momentum trade that you don't want to see the ringleader there go down. And so that's a risk there. And converse, tangentially to that, you have just the mega cap cohort itself, right? The weighting of those seven behemoths is so significant here at close to 40% of the S&P 500 market capitalization that you don't want to see disappointments out of that space. Otherwise, you're likely to see a decent setback in the broader market. You could get something like a spike in energy prices, perhaps a credit event that destabilizes the financial system, maybe even another escalation of trade issues with China that disrupts global trade activity. And then finally, just sort of the catch-all factor, if you will, is the geopolitical shock that upends global economic and earnings growth prospects. And none of us know what that could be. We have various theories, obviously, on what that could be, like China invading Taiwan, or something happening in the Middle East that really disrupts oil supplies. Just don't know, but the market will tell you how significant it is if it happens, because it will basically assess that shock, and the market setback will be proportional to the degree to which the market thinks it upsets the earnings growth outlook. So we've had some geopolitical issues obviously come to bear here, but with the market at record highs, we can make a statement that's would indicate that the market is not overly concerned right now with what it sees on the geopolitical front.
You've outlined quite a few potential trigger points here, but I'm curious, are there any signs that any of these risks are already emerging?
Well, one thing that we do have to keep a close eye on is that inflation trend, and we've seen it creep up since April. Obviously, when we first caught wind of the tariff matters coming to light in a big way, and while there's been trade deals worked out to help mitigate some of those onerous tariff rates, you know objectively, the core PCE price index is moving away from that 2% target, and we still haven't necessarily seen enough time pass, so to speak, to determine if the bulk of the tariff impact has been weathered here. And we're going to see that in the next few months, probably in the next 2 to 4 months. We'll get a better feel as to whether we can make that deterministic view that tariffs are not having the adverse impact that a lot of economists expected them to when they were first announced. And so, but if we get that inflation rate going above 3%, that's going to be problematic here for the market and for the Federal Reserve, which of course is right now trying to pay more attention to the employment side of the mandate, but it's not going to ignore that other side of the mandate if inflation pressures pick up and you start seeing a trend of rising inflation again that has a three handle on it. It's just not going to suffice for, we don't think anyway, for a Fed to be willing to cut rates aggressively like the market thinks it will.
Yeah, and that's interesting, considering how closely we watch CPI and the habits here. The consumer spending has been primarily the backbone of this cycle. What are you seeing under the surface here, and is it still holding up?
Yeah, I'm glad you brought it up, Jim. Look, I mean, the consumer in aggregate is holding up very well, but the qualifier there is in aggregate. I think we've heard from a number of companies how lower to middle income consumers are feeling stress, spending stress points from higher price levels, worries about job security. But it's been the upper income consumer that's really been a linchpin here for the broader economy. You can see here on this chart, it's a chart of real PCE. Also has a pretty nice trend line, and what I've done here, I've circled on the right side of the chart, kind of it's more current in terms of how trends have been breaking. A little bit of moderation leading up until this last report for August, which showed some pretty solid growth in real PCE, up 0.4% month over month, and up 0.6% on a nominal basis. And so that was a welcome sign and a comforting sign for the market that took away some of the concerns about stagflation, because if you have a strong consumer, you can continue to see the economy exist on a growth trajectory here. And so that was a good thing. We're also seeing here too in these charts of basically debt service ratios and delinquency rates. Seen a little bit of a pickup here as far as household debt service ratios and consumer debt ratios are concerned, but I would contend, based on the look of the chart, that it's nothing overly concerning at this juncture. Same thing with delinquency rates across a number of loan categories, whether we're talking consumer loans, real estate loans, or commercial and industrial loans. You're seeing a little bit of a pickup in those delinquency rates, but again, nothing too terribly alarming at this juncture. And the Federal Reserve has spoken to these very points, and that's why I think Fed's feeling reasonably good about the state of the economy overall, but it's mindful of that weakening or the softening that we are seeing in the labor market of late.
I'm curious, how much does the wealth effect from rising stock and home prices matter right now?
Yeah, I think it matters a great deal. As I mentioned earlier, the upper income consumer has certainly been a linchpin to this economy and in terms of their spending activity. And that activity has been supported by rising stock prices, which sit at record highs, and rising home prices for homeowners, certainly. And that has created some equity cushion in both respects. That has lent some confidence to spending decisions, and so that's a key factor here. If we were to see something break in the stock market and you see stock prices roll back in any meaningful fashion, we would also expect to see some slowdown in the consumer spending category that would then work its way into GDP growth, obviously, and that gets us into a worse condition economically speaking if we still are faced with higher inflation rates driven by tariff pressures. I'm not saying that's what we're going to see. I'm just saying that that would be a risk factor, because then you get stuck in that stagflation muck, and that's not what anyone really wants to see at this juncture. So we do need that wealth effect to stay intact for the most part, and we'll see what happens here. But so far, so good in that regard.
So with the quarter coming to an end today, we're just a couple weeks away from earnings season. So as such, earnings estimates have stayed surprisingly firm. How long do you think this can continue?
Right. Well, this is the chart I was referring to earlier that I was going to be showing everyone as to why you saw the encouraging trend line in the S&P 500. So we have an overlay here of the EPS estimate trend for the forward 12-month period, and you can see them moving, pretty much in lockstep here. And so we have a forward 12-month estimate right now, just under $293 for the S&P 500, according to FactSet. We're looking at third quarter earnings growth just shy of 8% right now, and that's up from about 7% at the end of the second quarter. And then forecast for the next quarter call for about roughly the same, but then we get into the first and second quarter of 2026 when earnings estimates are projecting somewhere on the order of 12 to 13% EPS growth in those first two quarters. And so obviously there's a lot of optimism about the continuation of this earnings estimate trend, and I think that it's something that could hold intact, assuming we don't see profit margins get hit noticeably from companies either absorbing those tariff pressures or perhaps raising prices that then create some pushback on the part of consumers. And so it's a delicate balance here, but there's been nothing really in the market's mind anyway to upset that view that earnings estimates should come through in the optimistic way that the market is envisioning them. But we'll certainly know it when we see it if that's not the case.
Is there a sector or maybe a theme where you think the street may be too optimistic or maybe not optimistic enough?
I think that's a leading question, Jim. About
Well,
you might be referring, I don't know, the AI trade. There's plenty of optimism, and let's just say justifiably so in terms of the AI growth potential here. You can hear it and see it in terms of the CapEx spending levels that are just enormous. And you hear it in, all the leaders of these technology companies who, were around to basically manage through the dot-com days, tell us that, this is not like that. It's even, more significant than that. So there's something to that, so I wouldn't say that, yeah, there might be some over concentration in some certain names within that area, um, but that's true of any bull market, right? You're going to get into those situations where you see just a lot of momentum, money kicking in here, and a handful of favorites that seem to command all the attention. But so you could see a little bit of over optimism in some of those areas, but you still have some good secular investment plays in terms of the cybersecurity space, right? And then also just in terms of really the related to the AI, you're going to have these data center build outs that filters its way down into areas like even some commodities like copper, and then even into the utilities that are going to help generate the power needed to drive those data centers.
Given everything we've covered, such as rich valuations, resilient fundamentals, and also clear risks, how should investors be positioning for Q4?
Right. Well, I want to tell our listeners here today that, I've entitled this slide a public service announcement. And really, it's a pretty plain vanilla recommendation, frankly, at this juncture. But I think it's necessary because when you have a market that is sporting the premium valuations that this market is, they can continue to go up. Valuations continue to expand, stock prices continue to rise. But you do need to be prudent in terms of risk management strategies. And this is an opportunity, we think now, where you do employ some of those tried and true textbook approaches to diversifying an investment portfolio. One of which is just a simple act of rebalancing, out of those areas that have done extremely well, and reallocating to those areas that have trailed. Right. So that would be, sectors with less demanding valuations at this juncture, which would, include some of these more defensive oriented countercyclical sectors like healthcare and utilities and consumer staples, even real estate as well. It's just a practical and prudent thing to do for long-term investment management. You buy low, you sell high. And this is an opportunity now, I think, to rebalance into some of those areas of the market that have certainly been left behind this growth rally. So that might lead you also into areas like into the value factor as well. You might even consider then looking to add some exposure on the bond side of things, favoring bonds that have less duration risk. Maybe raise some cash right now that you can deploy in the event we do get a market downturn. Maybe not see that market downturn in the fourth quarter. Just don't know when, but in the event we get one, you'll be ready to act on it and to buy into the weakness if the conditions are right for doing so. Talked a little bit about allocating money to some more defensive-oriented sectors in the event we don't get the economic growth the market thinks is going to come to pass, and then diversifying into alternative assets like real estate and commodities, and then even looking at some foreign markets that certainly get you diversified away from just the S&P 500 and the U.S. concentration. So those are some elements or some approaches that I think are worth undertaking at this juncture, given how far we've run, how rich valuations are here, and knowing that there is still an uncertain outlook here as it relates to a lot of policy matters.
We've talked a lot about the broader market and macro conditions, but are there any individual names where we might see the best risk-adjusted opportunities right now? Defensive sectors, international, and as you mentioned, maybe some alternatives.
Right. Well, I wanted to just highlight a few of the individual stocks that our analysts at briefing.com like right now. I don't want to spend a whole lot of time on this. Truth be told, I'm not an individual stock analyst, but I can tell our listeners today if they have any questions about the stocks that I'm going to just briefly go over, please feel free to email us, and our analysts will be happy to respond to those questions. But 7 names here just to highlight a few of them that kind of fit into the AI growth play. There'll be MongoDB, symbol MDB, and Arista Networks, symbol ANET, fit into that basket. And then several names that kind of fall along the lines into that interest rate play. So you have, Jefferies, diversified financial services company. They actually reported their earnings this morning. They looked pretty good all around here. You also have Clear Secure as a separate entity here. That's not falling into either one of those baskets. It's just an interesting growth play in our estimation. for the secure identity market using biometrics. But Affirm is another one that would potentially benefit on the interest rate side of things. We also have Harley-Davidson, motorcycle manufacturer, that should be in a good position or to do better based on interest rates coming down. Tudor Perini, construction services company, you get lower financing costs. That's going to help, lend to the ability to take on new building projects. And then finally, Radian Group, symbol RDN. It's the nation's largest and oldest private mortgage insurer. So if we get a pickup in home buying demand based on lower mortgage rates, then a private mortgage insurer like Radian would presumably be in a good position to benefit from that element.
All right, let's take the opportunity to shift gears a little bit here. We've had some great questions come in from our audience. Let's take a moment to get to those. And probably one of the questions that many have out there, how many more rate cuts do you expect from the Fed before the end of the year?
Well, I guess that is the question of the day, right? So I can tell you that just before our webinar started, I did take a look at the Fed funds futures market and saw that there was a 96% probability of another 25 basis point rate cut at the October FOMC meeting to 3.75 to 4%. And then looking at December, there was just about a 76% chance or probability of a second 25 basis point cut to 3.5 to 3.75%. That was up from about, I think, 70% or so a day ago, maybe 66% about a week ago. So I can tell you that the market is leaning more heavily in favor of 2 rate cuts before the end of the year. But the question, of course, is what do we think at briefing.com? Frankly, we think 2 rate cuts before the end of the year is at least 1 cut too many. And I say that knowing that, we just had the Atlanta Fed GDP Now model estimate project 3.9% real GDP growth in the third quarter. And then you pair that with a core PCE price index at 2.9%. That's really not a combination for a lot of aggressive rate cuts here. We might get some employment information later in the week. I say might because we also might not if the government does shut down and we don't get those figures released by the BLS. But there's a lot of data yet to be had here between now and the October FOMC meeting that obviously all the Fed officials are going to be watching. We do think that October is pretty much a guarantee for that 25 basis point rate cut. But the jury's out on a December rate cut. And I guess I should add here, Jim, I think we asked our registrants when they were signing up for the webinar to give their sense of, how many rate cuts they thought there would be. And just to let everyone know, 8% of our registrants said there would be no cuts before the end of the year. 51% expected 1 rate cut. 38% were expecting 2 rate cuts. And then 2% of our registrants thought there would be 3 or more rate cuts. So that'll give everyone a little perspective on where things fall right now.
All right, and another one comes in from John, and he asks, how much of the AI spending is using debt?
Well, John, quite honestly, I haven't looked at it enough to give you a really factual answer in that regard. So I'm afraid I don't have that answer for you today. I mean, I'd be happy to look into it further and give you a more factual answer. Because it's a broad category, in terms of we've had a lot of announcements about how many dollars are being allocated to these CapEx plans to build out the data centers, but I haven't seen a breakdown in terms of how companies are expecting to finance that, whether it's via cash or cash and debt, and what those plans are. So I wouldn't want to speak out of turn and give you a number that just isn't accurate. So, but thank you for that question.
This one's a little more urgent, Pat. This one comes from William. What will the market do if the government shuts down?
Well, yeah, typically the market doesn't overreact to government shutdown efforts. I saw a study out today, I think it was by B of A Securities, that looked at past government shutdowns and since I think 1995, and actually the average return during the shutdown period was about 1%. That's positive 1% during the shutdown period. So market tends to see its way through these things, cognizant that they do get worked out. One of the things that's being talked about now, though, is the risk of this being a more protracted shutdown and that having perhaps a larger economic impact than some of the prior shutdowns did, because it will drive more firings, frankly, in the federal workforce. President Trump has indicated that a lot of agencies will be asked to not just furlough employees, but fire them on a permanent basis in the event we do get a government shutdown. And so another statistic that's been bandied about is that for every week the government is shut down, it has about 0.1% of an impact on GDP. So there can be some economic impact here if we have a protracted slowdown. But the market, again, tends to see through that, because on the other side of the slowdown is the reopening that would drive increased activity on the other side of things. So net market shouldn't overreact too much to this possibility of a government shutdown right now.
And I think this one is applicable to you, Pat, as the Chief Market Analyst here at Briefing. Do you have any sentiment measures that you look at, or any favorites that you might have? This one comes from Gerald.
Yeah, hey Gerald. Well, the American Association of Individual Investors puts out a nice sentiment report, every month, and I have not looked at it recently here to give you the answer in terms of where bearish and bullish levels stand exactly in terms of that sentiment gauge. But that's one I do like to pay attention to, and particularly right now in this environment where retail investor activity has been significantly influential as it relates to the movement in the broader market, and it's become a really important investor class. Not that it wasn't in the past. It's just that it is an investor class that seems to have more sway these days that the institutions really need to respect. And so, you see, sometimes conflicting reports about these sentiment levels in terms of, whether funds or individual investors or professional investors are under allocated to the market, even at this point, with it being at a record high. But that would be one area that I would encourage you to look at as well, to get a sense of how bearish or how bullish individual investors are feeling about the market at this moment.
Well, I can tell you the last reading, Pat, we're a little bit above the historical levels we had. This was last week. The bullish indication was 41.7, and the bearish indication 39.2%. So quite balanced. The neutral was at 19.1, but both of those bullish and bearish indications are above historical levels. So a little bit of indecision going on right now, I'd say.
Yeah, right. And that probably helps explain some of the churn we've seen here at these record highs, because there's, I think a valid case to be made on both sides here as we move into the year end through this fourth quarter as to why the market could move higher or why it could move lower. And I think we're all in this waiting game here, somewhat tiptoeing around this inconvenient truth that valuations look pretty rich on a historical basis, but recognizing that fundamental forces have continued to support this ongoing bull market. And so there's just a little bit of some anxiety about the possibility of something disrupting that fundamental environment and there being a more material setback for the market. But, as we've mentioned, there just hasn't been, the market just has not gotten a sense that there's anything truly worrisome just yet anyway, that has availed itself to disrupt its bullish-minded position.
Well, I do have some good news and bad news. The good news is that we do cover the AAII investor sentiment when it comes out. Usually it comes out on Wednesday night, and I get to talk about it on Thursday morning. So we provide an update on that. And if you'd like to check that out, join us on the Trader Audio product. You're welcome to jump on in and listen to us. But with that said, that is all the time we have for today. I do want to thank everyone for joining us. Before I head out, please take a moment to complete our quick 3-question survey. It really helps us improve these sessions and gives us a chance to share the recording or get even more info on the briefing.com subscriptions. So, on the behalf of the whole briefing team, I want to thank Pat O'Hare for unpacking all this with us. And thanks to each and every one of you for being here with us today.